Welcome to Oregon Cash Flow Pro. My name is James Barber. I appreciate you joining me today for this. We are going to go over our H.Y.D.E portfolio. That's High Yield Dividend ETF portfolio. As you can see, Roth dividends are up, non-qualified dividends are down slightly, and that's because most of the dividends were reduced this week, but we added some more shares inside of our Roth accounts. Let's hop over and take a look at everything that's going on. But before that, let's quickly go over how we view these in light of our overall portfolio. The high yield dividend ETFs, you can see we're pushing close to $6,000 a month in dividends. That is not a return on investment. It's not a total return of $6,000. All of that isn't the income generated from these ETFs. Some of it is return of capital. Now, we actually had a really good week, and a lot of these had good appreciation until the end of the week, at least. And so there was a lot that was actually growth and that they made from income. But just recognize that these types of ETFs, it's not paying out a dividend based on all of the profits. Some of it is return on capital. So how do I look at this in light of the rest of a normal portfolio? Well, I kind of view these as rental real estate. We take a chunk of cash, we buy a property, and that property is going to kick off rents that we're going to use to pay back the money that was used to buy the property. Typically, that would be a loan. So we're going to use that to pay back the loan, and then it's going to continue to kick off rents in perpetuity as long as we keep it maintained and updated. These are kind of the same situation. If I take a chunk of money and we have let's say $10,000, because I did this back in January of this year with qdte, we took $10,000, we purchased a high yield dividend ETF. We're letting that pay back the $10,000 because that $10,000 was a loan. You can check out my video about that. I have regular updates with how that's going. We're taking the dividends, we're paying back the loan. The loan should be paid back in about 3 years, at which time we still have all of those shares that we purchased originally, and they're going to continue to kick off income. That's what we want to see. That's kind of what we're building here. We're building something that will eventually continue to kick off once it's paid back the initial money that we've put into it, and it's just all profit. And for me, as an investor, this suits me very well. I have a really hard time buying and holding stocks because I watch the stock market every day, and they go up and they go down, and I'm watching the charts, and we tend to hop in and hop out. My preference is to trade options, kind of like what these ETFs do to generate income. But that's because of the time that I spend looking at this. I find it hard to buy and hold unless I can do it in an account that I don't pay attention to. But these ones, I can pay attention to it. And even though they're going up and down, I don't feel like I need to hop in and out. I can buy and hold this. And that's because of how we view these inside of the portfolio. We're just going to continue to add to it, knowing that eventually it's going to turn positive. Whereas if I'm just investing in a stock company, I'm buying a stock, I don't know if that company is going to go out of business. It's going to go up, it's going to go down. I'm going to have to pay attention to if it's being profitable or not. What's the overall sentiment in the market? What's the overall economy doing? Like all of these things that ultimately will lead to whether that particular ticker is going to go to zero or not. Because any one individual company could go to zero. And we could just invest in index funds, low-cost index funds. And there's nothing wrong with that. I do have exposure to the low-cost index funds in a different part of my portfolio that's not actually in the stock market. That's my high cash value life insurance, specifically my IULs, where I get exposure to the upside, but not the downside. The safety of that, along with my whole life insurance, which I get guaranteed growth, both of those are downside protected, allows me to be more speculative in the market and expand my real estate portfolio, which is actually these. Now, I do actually have some real estate as well. I've got a couple of commercial buildings. So we do have a variety of investments that we're invested in. And this tends to serve me very well with this type of fund. I can treat it just like I'm expanding my real estate portfolio, except I don't have to deal with tenants. I don't have to deal with termites. I don't have to deal with property taxes. So with that said, let's hop into this And if you have a different view on these things, let me know in the comment section below, because I'm interested in how other people are finding a place for this inside of their portfolio. What are you using to fund it with? What's the alternative? So like the money that we put into this, we could have done something else with it. What are you doing with it instead of what you might otherwise be doing if you have a portfolio like this? Or if you're just considering starting a portfolio like this, what's the information you're looking to find so that you can see how to place it in your portfolio? Now, I'm not licensed to give you stock advice and to tell you what you should be investing in this, but I do think that there's value, and this is why I share this on this channel. I think there's value in sharing what I'm doing, and we can all learn from each other. So let's have a conversation about it. Definitely interested in hearing what you have to say. Now, we're tracking our portfolio in a spreadsheet. We have an incredible spreadsheet that was initially put together by Dividends on Repeat. You can check them out on YouTube. Pick up their original spreadsheet. If you just have one account that you're tracking, that's what their spreadsheet was designed for, and it works really good for that. I have multiple accounts across multiple brokerages. I needed to be able to account for all of those. So we tweaked it a bit. We added some pages, we added some charts where we can visualize these things and we can see what the dividends are paying out. How does it look in relation to our total cost? And can we track it across multiple brokerages? So we added some tabs to their spreadsheet. It's available to our Discord members. If you want to become a Discord member, you just need to join as a YouTube channel member or a Patreon. It's just $1 a week, and it basically keeps the trolls out of the Discord. But hop on over there and you can get the spreadsheet. You can see the spreadsheets of any of the other things that we're doing in here, because we've got some challenges going on currently that we're tracking with spreadsheets. You can see this is our Roth account summary. We have our total cost paid. This is the summary of everything that we have going on. We do have this in a visualized chart here that I'm going to show you in just a little bit. But from the raw numbers, we've got our current value, which you can see is down. That's because those dividends, a lot of it is return on capital. You have our dividends to date, how much it's paid out. This is our current projected monthly dividend income based on each of our holdings here. And then we have, are we in the red or the green based on total return? Now, altogether, we're in the green, but some of these things went backwards. Everything was green last week. Now we've got some that are in the red. xbty taking the biggest hit of the week. Now, Bitcoin was down quite a bit, which kind of explains that. Same thing with msty. msty came down yesterday quite a bit, or day before yesterday quite a bit. And then coyy also taking a bit of a hit, as well as the dividends have come down a little bit. So we are getting just a little bit less dividends. We did have an 8-month timeline on coyy until money printing, and that's now up to 9. We did also add some shares inside of our Roth. So we're up to 415. We do like this position because of how quickly it returns our money, even if it's just mostly return on capital, which it hasn't been. But even if it is, we'll still own those shares after 9 months or 10 months or a year, however long it takes to get that back. So we're still going to own these shares, but we'll have all of our initial capital back. That's what we're shooting for on this. This is where it says months until money printing. So that's the goal right now. Coyy still in the lead based on their dividends. Blox, this one is one of the longest time frames here at 36 months, but their strategy is different. This is exposed to crypto, but they're also selling put spreads and call spreads on some particular tickers. They're exposed to Ethereum and Bitcoin, and their goal is to increase the NAV, which has been working very well so far. And even with the big drop, we're still positive. That's pretty good. We were up like 14% as of last week. So we did see a bit of a drop here with Bitcoin and the other coins coming down this week, but we're bullish on those long term, and we think they're going to come back, and so will these. ULTY doing pretty good as well. Dividend holding steady in the 9-cent range. xbty, obviously that was the one that took a big hit. The dividend also lower than the last 3-month average. This one's good here. You got the 3-month average and then the last dividend paid. And you can kind of see LFGY went up. That was a good one for us this week, as well as the value of it went up almost every day for the last week. So that one's been a good one. qdte, dividend holding steady, slightly above the average. msty holding, actually msty came down a bit along with the value. So like Misty's struggling and it's a monthly payer. I'm not a big fan of the monthly payers because I would rather have that money kicking out to me so that I can go put it into something else without having to wait quite so long. But we're just going to hold. Not every rental property you buy is going to be successful. This may end up being one of the ones that is not. We shall see. xbty, dividend down a little bit based on the average. ULTY, holding steady, barely down a little bit. Blox, up slightly. And then coyy, down. So all in all, dividends have kind of dropped a little bit. But that's okay. We're still on track to continue earning fairly consistent dividends and working on paying back the money that we initially invested. Let's see what this looks like from a distribution standpoint. Here are our distributions for this last week. They started on 9/20. So from here down, these are all of our distributions from this week. Up here, we get it automatically totaled inside of our spreadsheet. And you can see this one's up quite a bit, but that's because we get that monthly MSty payout that's added into this one. And LFGY being up, LFGY is our biggest position. So we ended up with a bit of a bump because of that as well. The last time MSty paid out was up here. So we're up significantly, but that's mostly because we added some shares. From a visualization standpoint, here's our bar chart, and you can see those dividends coming up. And then here, we added this bar chart last week. Well, we added to it, and we're tracking. Here's the dividends that have paid out so far in blue. Our cost is in green. Red is the current value. Yellow is the total return. So we like seeing the yellow above this green. It would be great to see the red above the green, but eventually we're going to see the blue above the green as well. So blue and yellow should be above this green at some point on all of these. That's our goal. If it doesn't ever get there, that's a failure. Now, the other thing with this, is there opportunity cost? If we put some money in one of these and it fails, absolutely. But we never know what's going to be a good investment until it plays out. We can always look back in hindsight and say, oh, you should have done this or you should have done that. All right, well, we're not going to play the what if game in that scenario. We're going to buy, we're going to hold, and we're going to watch and track it. Now, if something fundamentally changes, we may end up getting out of this. We may sell that rental property if it's underperforming for some reason. Now, I don't anticipate selling any of these, mostly because we do have an outlook that's positive on Bitcoin and crypto in general, which msty, heavily invested in Bitcoin specifically because the underlying is strategy, MicroStrategy. Blox, similar situation, but Blox has a way to generate income. Misty isn't really generating income outside of Mastar, whereas Blox has a mix of things that they're generating income on. We like that diversification. Same thing with ULTY and LFGY. These are a basket of stocks. qdte, the underlying is the triple Q. We like that exposure to the triple Q, and it's actually been very beneficial from a total return standpoint so far. coyy is based on the underlying Coinbase, and it's kind of like buying into gold, except you're getting into the gold miners, the people who provide the equipment for it. So they have an exchange. As long as crypto is being traded, Coinbase should do well. So we have a good long-term outlook on this, even though it is based on a single underlying, like Misty is with Mastar being the underlying. Anyway, cool chart to watch and pay attention to. Let's see how our cost basis changed. Here's where we've added over the last week. So these four are what we added. We added 100 shares, 101 shares of coyy, 3 shares of Blox. And this is where it tracks our average cost across all brokerages. And then among each brokerage, we have our totals as well. So we can make sure everything matches up. Now, the other thing that we have is we're tracking how much do we have exposed to any particular fund, because there's a number of companies that are offering these things. We want to be a bit diversified. We don't want to have all of our eggs in one basket. You can see we're now under 60% in YieldMax. We were well over 60% just a few weeks ago. We've added to Granite shares. Granite shares now pushing 23. That's because of coyy. coyy, xbty, those are our big Granite shares investments. We've got Blox, which is coming up. And then Roundhill. Roundhill has the qdte, and Blox is the Nicholas shares. So there's our whole portfolio with the Roth I like where this is headed, and we should continue to see this go up as these dividends kick out and we continue to reinvest them. Moving over now to our non-qualified accounts. These are all of our after-tax brokerages. We've got $47,000 that we've paid into it. Current value at $43,000. We're up a bit because we've got a little more diversification here, but we are up higher than in our Roth accounts. Part of that is substantial investment in qdte, which has been doing good, and a substantial amount in LFGY, which has also had an excellent run this last week. Blox looking strong. gdxy, look at this one. This is based on GDX, which is a gold miners ETF. Numbers looking good on that. We don't have a huge position in it, but the numbers are good. And then we also have some exposure to bito, which actually took quite a bit of hit. Bito was looking really good, just like Blox, up until this last week, where it took a hit. We may be looking to add some more on this dip. We are looking to buy the dips on some of these things. Now, these ones are a little longer payback, 20 months on that one, 34. Now, this one's 34 because we haven't added to it in a while in our after-tax brokerage account. We're still at 8 on coyy, 29 for gdxy. We've had some good increase in actual value. You can see we bought in at 1609 and it's currently sitting at 1735. Gold's been doing very good. Total monthly dividend income, 2,400. So a bit less than the Roth. We are going to be adding to this. And in fact, we did add a little bit to this, except not in this spreadsheet. We're tracking it in a different spreadsheet because it's part of our 0% credit card challenge. We're giving this one its own spreadsheet. So we have a challenge going on now where we borrowed money off of credit cards. We did 0% balance transfers, some of those to our HELOC, where we were able to get the cash out, and we're investing it, and we're doing trades just like these ETFs would do. We're going to try to earn the income. One, to cover the cost of all of the money that it cost us to do the balance transfers, as while it's a 0% interest, while we have it on for a certain period of time, there was a small cost to do the balance transfer. So we want to cover those costs, and then we want to have money left over when we pay those credit cards back. A big win would be we end up with enough money to pay off the credit cards and still have money left over within a year. Money or cash flowing assets. These are the cash flowing assets that I want to hold. So we decided to start accumulating with some of our profits, the high yield dividend ETFs that are going to start to kick off this income. And we're going to use that income to meet these minimum payments that we have to make on the credit cards throughout the next year. So here's what we've added so far. We definitely need to increase this. Look for our 0% credit card challenge update to see the details on this one. But this one's currently kicking off $275 a month if the dividends hold where they're at now. We're going to get this initial one after our initial purchase. So we definitely have $67.39 coming in so far because that's going to be the first payment from purchasing these. And the payback period, 8 months and 37. We did this intentionally. Blox, we expect to see the value of the underlying shares go up. coyy, hopefully it goes up, but we actually expect it to pay back what we've paid in for the shares before we have to pay off these credit cards. So if I put $10,000 into coyy, I should get that $10,000 back in dividends and be able to pay off those cards and still have the shares left over at the end of that, which is our goal with this challenge. We can't put all of our money into coyy because that's just too much risk. It doesn't meet our qualifications for controlling risk throughout this challenge, so that when we do need to pay back these credit cards, we have the cash available and we're never going to get stuck paying credit card interest rates. Anyway, check out that video if you want to see more information about that challenge. We're having a lot of fun with it. And you're going to see what types of trades that I engage in that will consistently bring in income, or how we're going to tackle certain situations in the market that we see. In general, I want to be able to earn income whether the market's going up and down. So that's kind of the strategies that we're targeting. All right, back to our non-qualified accounts. Let's take a look at these. The distributions. Here's this week's distributions. Total just slightly below the week before. We don't have any msty in this one. Wait, I thought we did. We do have msty. I didn't put msty in here yet. I have to look at so many accounts and pull in the dividends. I have not figured out how to automate this. So let's figure out, where do I have msty? Oh, that's why I didn't put in any Webull. Okay, everything is updated now. I forgot I hadn't done my public account or my Webull account and I don't think I had updated them all week. So we got all those ones put in, and now our actual dividend payout is higher than the week before. Got to be because of the LFG payout being increased. Nice to see a little bit of a pop-up. Only one of these accounts has msty in it, and that's Webull, and Webull has not paid me that dividend yet. Now, one of the things that's kind of nice about seeing all of this, I have 5 different brokerage accounts here in the non-qualified funds spreadsheet, and just look at who is slow to pay the dividends. It's kind of annoying. E-Trade pays the day after the dividend, which is when it's supposed to be paid. E-Trade, it looks like they pay it that same time, but it usually doesn't come in until the next day. So I actually didn't see this one. Let me scroll this up a little bit. I actually didn't see this until earlier today. Today is the 27th, and it doesn't actually show up in my account until the 27th. Whereas on E-Trade, it shows up yesterday. On Fidelity, it shows up yesterday. Public, they list it as of the day that the announcement happens or the ex-dividend date, but they don't actually give it to me in my account on that day. It is available the next day, I believe. So Public releases the funds to me same day that Fidelity does. Tasty Trade is a day late. E-Trade releases on the following day after ex-dividend date. Webull is behind by a couple of days. They take longer than Tasty Trade. What are they doing with that? Are they just taking advantage of holding our money for an extra day? Or are they just slow with the paperwork? I don't know. But it is kind of annoying because I can't update all of these at the same time. So the msty dividend that we get, I'm not going to be able to put in, I'm guessing until the 29th. Whereas I've already got to put it in from one of our other accounts. Here, Tasty Trade, we already got to put that one in. So this was in one of our Roth accounts where I have msty. Over here, I've got msty in Webull, and we're not going to get that for another 3 days. So they're very slow to pay that out. And we see the same thing here. When we look at xbty and coyy, E-Trade pays out on the 23rd. Fidelity pays out on the 23rd. Public shows it coming out for xbty on the 22nd, but it doesn't actually come out on the 22nd. Tasty Trade lists blox is coming on the 22nd, but it's actually a day after these other two that comes in. E-Trade lists it the same day there. And then Tasty Trade, yeah, those ones come in the day after. I don't get those on that day. And then xbty and coyy here with Webull the day after that. So very annoying. Get your stuff together, Webull. All right, this is all updated. Let's check out the chart. Here's what the dividends look like. There's our payouts. Here's the important graph. And we have all the relevant information right here too. And you can see our total return on LFGY, higher than our cost basis, msty, well below cost basis, but we haven't got one of the dividends yet, but it's not going to catch us up. We're definitely behind on msty. xbty was doing well, and it fell back this last week. So this one is significantly behind at the moment. Hope to see that one catch up. ULTY just barely behind, and then blox doing well. coyy just barely behind. gdxy ahead of the game, and bito just barely ahead of the game. And then you can see it right here in a pretty graph form. So remember, we're looking for the blue to overtake the green, which is our cost. We always want the yellow to be higher than the green. That's how we know we're doing really good in whatever situation we're in right now. Red is our current values. We want to see red higher than the green. That would be ideal. That would be a NAV increase happening. And then blue is the dividends. So yellow combines blue and red. Yellow will always be bigger than both of these two. But we would love to see all three of them bigger than our cost. All right, so back to the cost basis. One of the things I hadn't added in was a couple of purchases we made here from Webull. So we had added a little bit of coyy. And here's our breakdown. We're at 46% yield max, 21% round hill, 21% granted shares, 6% Nicholas, 4.5% pro shares. I like this distribution. We're going to continue to grow these and balance this out a little bit more. We have a little more flexibility for getting this balanced quickly than we do in the Roth accounts because we can't just add funds to the Roth account. I'm not currently adding funds to this right now, though, other than what we're growing it by with our trading efforts. So that's our portfolio. If you have any thoughts, comments, suggestions, put them in the comment section below. Let's have a conversation about it. If you're in our Discord, let's have a chat about it in the Discord. We have a channel dedicated to the high yield dividend ETFs there. That's where I keep a copy of this spreadsheet. So good luck to you all out there. We'll see you again next week when we catch up on this. In the meantime, be sure to check out our other videos. I do a ton of videos educating people on high cash value life insurance. We do the optimized designs that minimize expenses and optimize for cash growth, and it is a great tool in our wealth building efforts. And then, of course, we have a couple of other challenges going on, our 0% credit card challenge and our $10,000 qdte challenge, which we're also going to be expanding that here. I'm going to borrow $10,000 more from one of my life insurance policies because I can borrow at 5% interest. I don't have any minimum payments due on that. I don't even have to pay the interest. But we're going to take that. We're going to be buying some more high yield dividend ETFs. And I'm thinking what I'm going to do is a 50-50 split between blox and coyy, something to get us some instant high returns on the dividend in coyy, and then something to help us keep that NAV steady and get some growth on that underlying with blox, as well as a pretty decent dividend. So stay tuned for that one. Good luck out there. We'll see you next time. The next 20 seconds determine your future. Subscribe, meet with me, or continue educating yourself with these videos right over here. I appreciate you. Now go maximize your cash flow.